if you don't work in this industry, there's no oversight. You could say whatever you want. Like, you guys could go on today and say, like, everybody should convert all their money to Roth IRAs immediately. Like, that's the best thing that you could do. There's nobody going to come after you. But if I said that and somebody, like, we would get sued. So, like, I think that's the most dangerous thing right now is, like, that there is no oversight.
All right, back to another episode of Talk of the Town. And we got our new friend here, Ben Tuscai from Sunpoint Investments. And he's in the financial planning world. Ben, welcome, brother.
Thanks for having me.
What's going on, Ben?
Always good to get out of the house. I spend too much time there. I was just telling you guys before we clicked play here. A lot of time spent at my house. So I was really excited to drive over here.
Yeah, and any excuse to get out of the house and get on the microphone, we love it.
Yeah.
Glad to have you.
Thanks for having me.
On this cold morning after a Birds loss too.
Tough day.
We won't even get into that. Let's get into the fun stuff here. So Ben, you're a financial planner. How'd you get into the space, and why did you get into the space? Like, why'd you choose that route?
Honestly, I got my master's degree, and I was like dead set on being an athletic director.
Oh, wow.
Until I was getting into it in grad school. I was working for the Phillies at the time, and I loved just being in sports. And then once I was working for the Phillies, I think it clicked where it was like, man, your social life sucks. Like, you work nights, you work weekends, you work holidays, and when you're off during the day, everybody's at work. Like, it was really hard to find like balance and things. And then I graduated, was trying to figure out like, the next job, and I had started at CrossFit Inspire in Malvern, and I met just a bunch, I felt like half of the members there worked at Vanguard. I had no idea. Like, there's probably 13,000 people on that campus there in Malvern. I didn't even know what Vanguard was, but there were so many people there, and I was like, I got to start paying these student loans back, and I need a job that's going to be able to do it. And so many, woman, Nikki, that I met there was like, hey, like, I could help you with your resume that's abysmal at this point, and I could help you get in the door. So that's what I did. And my mom was like, you're never, like, it's a finance company. You're never going to, sitting behind a desk is not your thing. Like, you got ADD. Like, this is not going to work. And I was like, well, it's a job. They're going to give me benefits. Like, going to figure it out from there. And I got there, and I had to take my Series 7 and 63 right off the start. Horrible test taker. And I don't know, just it clicked. I was like, man, I love it. Because it's so much unknown. I've never studied any of this stuff before. So, yeah, then I jumped off the career at Vanguard, and I was like, I'll stay here until I figure out the next, like, sports job that I could get. And it hit, too, when I was at the Phillies. All of these execs are, like, 65, 70 years old. Nobody leaves these jobs. Like, I'm sure some of those people die in those jobs. Because you get to go to Citizens Bank Park every day and hang out. That's pretty cool. So I was like, this is just, it's never going to work. So then I went to Vanguard. I stayed there for 8 years on a pretty crazy career trajectory of just like right place, right time. And then, yeah, I knew somewhere in there I had a few different jobs of like serving individual investors, like us, everyday people. And then I spent most of my career there actually selling ETFs and mutual funds to financial advisors, which is what I am today. I admittedly found much less purpose and value in that job. It just paid way more money to be doing that than actually working with individual investors. But there was a really like high purpose on the individual investor side, because you're helping people or having conversations of like, hey, have you ever thought about like your asset allocation? You're 80 years old, all invested in one ETF.
Oh, wow.
And like, or hey, you sold everything in your portfolio back in 2010 and it was 2016. Like, you missed the boat. And like, so it was really hard to see those situations, and it was like helpful to have some of those conversations. So that was like how I actually got started into it, and through a little bit of Vanguard.
Gotcha.
And how'd you kind of...
Vanguard's, there's so many people that work for Vanguard around here. It's nuts.
Around here, yeah.
Half the people I know.
or at least work there at some point.
Yeah, for sure.
Yeah, that campus is awesome.
Yeah.
Yeah. How'd you go from Vanguard to where you're at today?
Yeah. So when I was at Vanguard and I was wholesaling to financial advisors, I met a Matt at Merrill Lynch. He was actually like one of my first phone calls, Matt Ziegler, who's now my business partner, which was like, it's crazy what has happened over the past like 6 or 7 years. But he was a client of mine. I can't tell you why. I don't even know if he knows why he took an interest in me. But at that point at Vanguard, we had no sales training. $9 trillion firm. And 70 cents of every dollar that came into Vanguard at the time came in through the channel I was working in, FAS. You would have thought we would have had this like pristine sales training. No, like they gave me a book of business and said like, here you go. Go make it work. And you're like, okay, there's no data at the time. Like all you have is like notes in a CRM system that was built in the 70s.
Wow.
So you're like trying to figure, so like Matt was like teaching me how to do my job. And my leader at the time, Kathleen, who was total rock star, she was like, this is the weirdest relationship, but like keep doing it if it's working. Like he would meet with me every Friday at 10 a.m. For an advisor, that to give up an hour every week to some random guy was like a lot.
Yeah, that's strange.
Yeah.
I guess you would say.
It was strange. And then he was like, but I learned a ton from him. And I knew I wanted his job like pretty early on in my career at Vanguard. I wanted to be an advisor. I just wasn't sure how I was going to get there. So I just had to like stick around and figure it out. And, you know, you have your whole like personal life going on too. So I knew I wanted to get my CFP, Certified Financial Planning designation. And then I had to find the right firm. Matt was at Merrill Lynch. This is like no slight on wirehouses or broker dealers. Like I knew I wasn't going to be a good fit for that space. So I had to find an independent firm that I could work with. And of course, I'm coming with no clients. That's not very appealing for any business out there today to be like, okay, we're going to finance you until you grow. That's not always a good deal.
That's hard to do for both sides.
Both sides.
Your side and their side.
So you have to find this balance and who's going to take this risk for you, and like who are you going to really roll the dice. I mean, I had great benefits, an incredible compensation package. Like I had it all. And I had this career trajectory that I could have making a lot more money had I just stuck around. But Matt was going to Sunpoint. He was leaving Merrill Lynch, going to Sunpoint. I passed the CFP, I think it was July 8th, 2021. July 9th, 2021, Matt was on the phone with me like, are you ready to make a move? And I was like, this is such a funny, like, how this all came full circle.
It's almost meant to be.
Yeah. I mean, he was the second phone call after I passed the exam and after I called my wife. And he was just like so pumped for me and just like the amount of work that goes into that test. And I met with the folks at Sunpoint, Michael and Jack, Angela, Lee, Jocelyn, a lot of the folks that I work with today. And I was like, this feels like the right fit. And getting offered your dream job in your early 30s is like, that's hard to pass up. The tough part was I was going to take a pretty big compensation hit. So I went up, it was between like 40 and 45% pay cut.
Betting on yourself.
Yeah.
Big time.
Yeah. And like, also you need to convince your spouse that this is gonna, and fortunately, like Mary Kate, she was like, look, this is what you've been working towards for the past 6 years. Like if you say no to this, when's the next opportunity? And I was like, yeah, I don't know. She was like, we're just going to, like, we'll figure it out. And like, I hate that motto, by the way, we'll figure it out. Like that's such a bad financial like decision. And yeah.
Especially for a planner.
Yeah, for a planner, right. I hear that and I'm like, that's a disaster waiting to happen. So yeah, made the jump with Matt. I joined about 9 months after he joined with Lisa, his client services associate. So Matt, Lisa, and I together like work as like a team, and then the other half of my job is supporting the rest of the firm as the director of financial planning. So that's like somebody may come to me like, hey, so-and-so, one of my clients is thinking about retiring in the next 12 months. can you help me think through like all of these conversations? And then it's getting on phone calls with those clients of nailing out what actually that plan is going to look like, and it's unique for everybody. But that's been the journey so far, and it's been pretty remarkable.
Yeah, having that support system is definitely impressive, and that's so important in anything, really.
Yeah.
You were mentioning your clients. What you want to give us like a couple examples of clients you do serve?
Yeah, so most of who Matt and I work with are under the age of 40, maybe 45. And that is pretty intentional. And within that, like, it's not like, our target is to find people under the age of 45. But most advisors, if you ask them who their target market is, they're pre-retirees or retirees. Why? Because they already have the most money established.
Yeah, that's definitely what I hear. Or like,
if you ask
they're
any
basically
advisor,
retired people.
Retired people are like your bread and butter because they have usually the account is 7 figures plus. That's a good business model. What's harder to do is to serve the under 45 community who either has smaller account balances or most of their assets are tied up in 401ks, 403bs, retirement accounts. But the need is very high for that crowd. You figure when you're under 45, your income is not like probably at its established level yet. You maybe haven't hit the right career trajectory yet. You're having kids, you're buying houses, your parents are getting older. Like those are probably like the 5 key categories that all offer like unique planning opportunities. And you can obviously make some disastrous decisions at those points of your life that you wind up paying for 2 decades from now. But growing a business model like that takes, refinement. So under the age of 45, and most of those clients are executives or business owners. So people that have like somewhat uncertain compensation or very lumpy compensation, and then very unique like equity compensation as well. So it requires like intricate tax planning, a lot of like insurance reviews to just like balance things out, and then just making sure that we're making prudent decisions with those large sums of money that are coming in on less regular basis.
And what drew you to that instead of the more like common path?
It's a good question. I think it's because it's like who I was when I was at Vanguard. Like I was on the higher compensation side. Even with, I had my CFP for a few years at Vanguard. I still like the bias that comes into play when you're trying to make your own financial decisions. It's really hard. And I always tell people, I just talked to a friend who's a financial advisor that I'm hoping my wife and I will hire for us. And people always find it funny that like you're going to hire somebody to do your job for you. It's like, yeah, because I don't think about any of my own stuff. Like I have estate planning documents that are sitting on my desk unsigned. A prudent advisor would be like, Ben, like I'm an accountability partner. You told me you were going to sign those. Why didn't you sign those? I need that. Most people need that. But so I think it was more of like what drew me to this type of client. It's more like who I am under the age of 45, lumpy compensation, and then business owners offer, I am somewhat a business owner myself, like just within a larger practice. But there's so many opportunities within planning for business owners that it's really fascinating work. And rarely do business owners have the time to like step away from, they're wearing like 37 hats. Some of the people that we work with, they can't even think about what's for dinner tonight, let alone think about like, do I have the right business owner policy in place? So there's so much interesting things to do with them. And I think that's what, there's a high degree of purpose, I think there.
You said you work with like a lot of people that are getting lumpy income. Why is it? I've heard it's like harder to work with them than even like low income earners. Is that true? And why is that?
Yeah, because you're not, for the lumpy income, you're making like non-traditional decisions where like most people, almost everybody, if you're dependent on some type of income, you should have like a capital cushion or an emergency fund. Well, for lumpy earners, you just need a larger capital cushion on the sideline because like, what happens if that bonus doesn't, or that bonus is 50%? what do you do then? And that's like half of your compensation for the year. We probably need to be able to float for 6 to 8 months versus somebody else that is on maybe lower income, but it's stable. It's all salary. You could say, okay, we know what the monthly bills are. We probably need 3 to 4 months of an emergency fund, depending on your situation, and that'll be fine. The other thing that comes with the lumpy income is usually it's unique. It's not all paid in cash. Maybe it's restricted stock units, it's incentive stock options. It's things like that that are like equity compensation plans that require just like slightly more thinking. Because like, okay, you got an incentive stock option, that's great. One, you still have to go buy the stock. And two, they didn't just hand you cash. Now what? So you're technically still got a benefit from the company, but it didn't hit your checking account. So that's why I'd say it's just a little bit, it is more challenging and requires more thinking, but I think that's what makes it more fun.
Yeah, it does sound interesting. Like all the different scenarios and how to, those people are probably just thinking, oh, great, I got a bunch of money, or I have some options here, and what do I do now?
Yeah, it's I would say that the big one that's very common is restricted stock units. So what the company does, just for basic coverage here, is they've given you shares of the company that you work for, but it's taxed like they gave you cash. So as soon as it vests, it's taxed as ordinary income. It actually shows up on your W-2 as well.
Oh, wow.
So that's great. So let's say it's $50,000 of restricted stock units they vest this year for you guys. Well, you still owe tax on that money. It's not always withheld. And you owe payroll taxes on it as well. So that stuff, you need to account for it. Well, what happens if that $50,000 gets cut down to $25,000 because the company's not doing well? Now it's only worth $25,000. But you still need to pay the tax on it. So what people would do then is, okay, let me sell the stock so I can get cash. But you just lost 50%. So what people often do is they just get the restricted stock units. They do nothing. And then they get this huge tax bill at the end of the year. Like, wait, what the heck's going on? And the company's not doing well. You almost have like a double negative. And usually, this is not advice for anybody, just education. Usually what I recommend is as soon as it vests, sell it. You already paid tax on it, paid as a bonus anyway. So, and you already have concentrated risk because you work for the company. If they're not doing well, your bonus is probably not doing well, so your compensation may stink. And on top of that, you don't want to hold the stock as well. Like, we have too much isolated in one position. So oftentimes just like offload that. I know you may love your company and believe in it long term, but we could own it as a smaller portion of your portfolio and just diversify out the rest of the money. So all of those things are I think are a lot of fun. And it's not always where somebody just meets you with oh, Ben, great. Sometimes you get pushback. So that is always like, it's interesting. And that's the fun part about it.
That makes sense. That's cool.
Yeah.
That's a good example.
It does. So when there's a scenario like that and maybe you do get a little bit of pushback, how do you go about that situation?
I think at the end of the day, it's ultimately your money and it's your decision. And my job is more of like a partner. I just have to show you the blind spots, and I have to show you what the downside risk and what the downside and like the future drag on all of these decisions are. And that's part of my responsibility. I'll meet you with as much education as I can. If you're going to like dig your heels in the ground and say like, no, I am like in that scenario, I'm not selling this stock. Okay. Then what we need to do is like make other decisions to compensate for that decision that you're deciding to make. And at the end of the day, it's totally your call. I'm not here. I remind people often, I'm not here to tell you how to spend your money. I'm just here to help you develop the plan that like, okay, going to Starbucks for the 6th time today was not a good idea. Like I
never a good idea.
I'm guilty.
Even the second time's not a good idea.
So like I that I'm not going to babysit you from that perspective and say like, I go through credit card statements with people. It's not like a huge part of my job, but I'll do it if it's needed. But at the end of the day, like you're an adult. Now these apps today, like your bank statement, credit card, they like categorize things for you. Like, when you see you went out to dinner for like the 9th time, or you DoorDashed the 12th meal this month and you spent $700 on DoorDash. It's like, all right, you don't need me to tell you that. You could come to your own conclusion that that was not the best financial decision, but that's your life.
Yeah. No, that makes sense. You had mentioned like emergency fund or rainy day fund earlier. Kind of with like the economy now and everything that's going on. How much do you recommend being in that? And then with like the current climate too, a lot of people are like, well, it's got to be invested because you're going to end up losing money on that. How would you advise somebody, and then like what's your take on that?
Yeah, so an emergency fund I think is right for like almost everybody. If you have any income that you're dependent on, the people that I say maybe you need like a month worth of it is if you're retired, you have income from your portfolio and Social Security, maybe a pension or something like that. Like most of your life is kind of fixed at that point. And if you needed money from your assets, like if we're advising the assets and you needed, hey, oh my gosh, my car died and I need $5,000. Okay. Like for most people we work with, that's not an issue at all. Like, okay, we'll get the wire out tomorrow. For everybody else that doesn't fit in that like very small, unique category, you should have an emergency fund. Now, what that emergency fund is usually is between 3 and 6 months of your living expenses. And that's not rainy day money. That's like isolated. Usually I say have a high yield savings account that you put it in a place that you're not going to be tempted to touch it. So if it's with your advisor, for some people, they put the money with us and we just leave it as cash. That's fine. Open up a brokerage account with like a Vanguard or a Fidelity or something like that. That's fine as well. Because it's at least like one step away from logging on your bank app and let's go to Italy. Yeah. That's not what we want that money for. This is like you lost your job, your spouse lost their job, something tragic happened in the family. Like that's what that money is for. So like somewhere 3 to 6 months. And that range depends on like kind of your risk appetite. If you're okay stomaching some risk of like, if I lost my job and I want to be on the short end of this, 3 months, okay. Like if you're okay with that risk. The other area that you should consider is, especially if you're married, if one like significantly out earns the other. Because if like the wife's making $400,000 a year and the husband's making $100,000, that's usually when I'm saying we should have 6 months. Wife loses her job. We need 6 months before she's going to find another job that pays that. Typically, if you're losing your job, like maybe there's like a macroeconomic issue that's going on in the economy that like things are slowing down. We want to buy ourselves some time to be able to make sure that like we're not swiping credit cards for things like that. So that's how I think through like the emergency fund. As far as like the economy today and just like investing in general, I think, of course I worked for Vanguard, so they always have like good charts and like really good white papers and things. Investing should have very little to do with what's going on in the macro environment. If you think back, I mean, many of us we were all probably in high school when the global financial crisis was going on. But if you looked at the headlines from 2009 until 2011, they were like doom and gloom. Like it's gonna tank again. We're not gonna so you had all this negative news every single day. Politics were crazy. Market was up 100%. So like, just because economy is slowing down doesn't mean the market itself is slowing down. What I always try to remind people is like the Apples, the Googles, the Amazons, the Nvidias, their goal is to generate as much profit every single year. They have weathered so many storms at this point. Sure, they might have a pullback and have to like weather some more blows, especially depending on who's in the Oval Office, tweeting or writing whatever they're doing on a regular basis. They're going to have to navigate that stuff, but they've done it before, and their job is to make money. I'm investing regardless of what's happening there. I pay very little attention to what is going on like in the macro environment from just an investing perspective. Obviously, I read the news quite frequently. It's like good to stay informed, but it does for us as a firm, it does very little to influence our decisions.
Gotcha. I kind of want to ask you the same question you asked, but through like a business owner's lens.
Lay it on
the
me.
Safety net, and if you could talk me through that.
Yeah, business owners, it's probably a bigger safety net. Because if you lose your job as a business owner, like you don't need 6 months, you might need 12 months of cash on the sideline because it's going to be either a longer period before you start the next venture. You might have debt that's owed on the collapsed business, depending on like what liens and documents are in place. And of course, if you have a family and you have kids and you have like all the, like you have to take care of, like the bank's not going to say, hey, Matt, don't worry about the mortgage this month. I know your business went under. Like, nah, it's due on time. So like we still need to account for that stuff. So from a business owner's perspective, I think it's just a larger capital cushion because what oftentimes too gets like bled together is a business owner has like two different types of financial planning, the business owner side and then their personal side. And sometimes we start bleeding stuff together because there should be overlap in certain areas. But we should think through like capital cushion for the business to stay afloat and then capital cushion for your life to stay afloat. Because the business could slow down and you could run in the red for 6 months. Okay, we don't want to build a bad credit line because we didn't plan properly. So we should have a capital cushion for the business. We should also have capital cushion for our household as well in the event of like total collapse or something else goes on in your life.
For sure. Yeah, that makes sense.
Yeah. What are some like common mistakes that you're seeing right now that clients are making that maybe are just keep coming up that you're seeing?
I would say this time of year, the biggest one, and I think I just wrote about it in our newsletter 2 months ago, is like open enrollment. Open enrollment is just wrapped up probably or is about to wrap up for most. Like Medicare open enrollment, I think, just closed yesterday. So open enrollment is like a unique time of year where you have to select benefits for like future needs. We don't have a crystal ball. Like you have no idea what's going to happen next year. So most people though just go in, they just click that button. I think the stat is the average person spends like 18 minutes doing their open enrollment, which I think for some people is actually longer than they actually spend. Yeah. It's probably like 7 minutes or something like that. It's 18, like, yeah, wow. next, submit, done. Don't even think about it. I do a lot of clients of Matt and I's like will reach out for open enrollment just to say, hey, could we just do a screen share so we can, its benefits are probably gonna be the same. Can we just think through this? So I see that as like a common mistake where people just say, okay, but like you didn't take into consideration like, oh, you had a kid. Should you be on that high deductible plan again? Like, I don't know. Like what's the company offering? Oh, now you have 3 plan options. Last year you only had 1. Like, let's look through what that actually means for you. Are your doctors still in network? Those are the things that they're not fun things to do. Don't get me wrong. Like, I get it. It's boring for most people to think about, but it's stuff you have to consider. So that's one. Estate planning is always like, look, that process sucks. It's not fun. There's only at the end when you're like, I'm done. Oh my, and it does feel like you get this weight off your shoulders. But like the amount of times that I've seen the wrong beneficiaries on accounts, or no will, it's such simple stuff. Or like you have no power of attorney. It's like, oh my God, mom's in the hospital. We need to file our taxes. Or like, and nobody has the authority to do that because we didn't. So you see some of this stuff and you're like, if only people knew that like we could create a plan that would help everybody in the family out. The worst one I saw is a woman that was named as a beneficiary of her ex's retirement plans. He died. And of course she comes and asks me for help. And like, when she asked for help, I was like, surely she's going to say, how do I get myself out of this situation? Like, that's not my money. No. her plan was like, how do I get access to that money? And like, now I'm in this moral dilemma of like, you know, what you're saying was not what was matched on those documents. And by law, this is your money. Morally, that's a different conversation. So,
damn, that's a tough one.
That is.
That
is real hard.
Ooh.
For me, it was, I don't think I'm the right person for this. So like, just let me, and it was like a friend's significant other at the time. And I would just, hey, look, I can't, just morally, I can't do this. So I stepped away from it, and it was like, and I think my understanding of it was she took the money. So like, yeah, obviously that's a tough situation. But so estate planning is usually the big one, open enrollment. And then I would say probably close third. These are all like the higher risk items, is just on the insurance side. I don't sell insurance. I just advise on it of like, I don't care who you buy the policy through. Let's just find you a good policy. So either they have like no life insurance in a high risk scenario where like, oh, you have kids, but there's no life insurance. Or they bought like some whole life policy from their friend that worked at insert firm here that I don't want to throw under the bus on this podcast. So you have those are the situations where it's like, at least in the whole life scenarios, like somebody's going to get paid if you pass away. I see a lot of times where you're like, you are severely underinsured. Like that, like $200,000 is a lot of money. But like $200,000 is not a lot of money when you're considering like, oh, you have 2 kids and your income's no longer here. How long could your family actually last? Like, what are they going to make it? 2 years until they have to like sell the house, or there's no more, oh, we're not putting any money away for retirement. The kids are going to be on their own for like college expenses, whatever it is, whatever your plan is. It's thinking through those things. There's just like, that's probably where I see the most mistakes.
That makes sense.
It does. And then question I had too is you see on social media, whether it's LinkedIn, Instagram, any of them really, everybody has an opinion. What are some of the most, what are some money advice people give that are actually hurting more people than helping?
There's so many.
There's so many.
It's like
these are good. Like social media is such a double-edged sword, because I write on LinkedIn. We recorded our webinar the other day. Like, you know how many disclaimers have to go on everything that I do? Everything I do is tracked. Emails, not phone calls, but like all that stuff has to be logged. If I write publicly, it's like goes through a ton of scrutiny. If you don't work in this industry, there's no oversight. You could say whatever you want. Like, you guys could go on today and say like, everybody should convert all their money to Roth IRAs immediately. Like, that's the best thing that you could do. There's nobody going to come after you. But if I said that and somebody like, we would get sued. So like, I think that's the most dangerous thing right now, is like that there is no oversight. Now, I don't know what it would look like, so I don't have any recommendations there. But there's a few examples. So I mentioned whole life, like the be your own bank thing of like, okay, I'm going to buy this whole life policy. I'm going to sock money into it, and then I'm going to borrow against it to like buy other assets. My question is always, why did you need a whole life policy to do that? Why not just have a term policy and go buy that asset in cash instead of paying it to an insurance company? That doesn't make any sense to me.
Right.
Whole life policies are great for the right scenario. I just don't see it as a be your own bank thing. Like that's one where I see it. Typically, I know that the person on the other end of that video doesn't know what they're talking about.
I've seen a lot of those.
Yeah. Oh, that's probably is like
big,
like one of the top ones. The other is like on the business owner side is taxes.
Oh,
the taxes is like, again, if you're not a CPA or like an enrolled agent, you can say whatever you want.
And unfortunately, those are the people I feel like getting hurt
Yep.
because they are saying
It's
what they
attention.
want.
It grabs your attention.
It grabs your attention. It is so appealing. I mean, but the deductions that people go on and talk about for business owners, like, oh, just start your own LLC, and you're like, okay, that's not the way this works. Also, like, you don't need an LLC to be considered to have like sole proprietor income. You could be selling necklaces at a fair, and you have taxable income like that you should be filling out the correct documents on. But like, oh yeah, just start a business and then you can deduct like all your car expenses. Like,
That is kind of like what you hear.
they love
eventually.
that Section 179. They love Section 179. It's like, oh, the car weighs more than 6,000 pounds, 100% deductible. It's like, yep, okay, that's just not true. And also, you went and bought a G-Wagon for $100,000.
Right.
You still had to spend $100,000. And for most people, it's like, what's your effective tax rate? 20%? So you get a 20% deduction on the 100 grand. You saved 20 grand to spend 100 though?
Yeah.
That's a brain
It's not
dead
the
decision.
the
Like what?
mindset.
For sure.
It doesn't make any sense. Like those are probably anything tax related seems like it's always either overblown or totally misstated and false. And yeah, the whole life thing is that's probably taxes is a number one. Whole life, at least there's like a benefit because you have some protection in place. But oftentimes people are holding whole life policies that should never have a whole life policy.
Yeah.
That makes sense.
Yeah.
Oh man,
There's some good ones.
I hate like once you start scrolling and you see some of those posts, you just get more of them too.
Yeah.
So it's like
Yep.
they just hit you from every angle. But it's part of the game, right?
It's definitely part, and it's hard as like somebody that's creating content. You're like, I have to give the disclaimers of like or highlight the boring factual information that's not as like eye grabbing or
it's not
like
as juicy.
it's not as
Right.
juicy. It's
Yeah.
like I can't make some crazy claim or I get in trouble.
Right.
Yeah, and those are the ones that are getting the eyeballs because you're like, huh?
I mean, I watch it too. So like,
Yeah.
I'm on there. It comes up on my feed, and I'm like that's wrong. That's blatantly wrong. And I'm always tempted to like comment, like, okay, you have to explain more than just this.
Right.
But it always lands. It's all of them always land with one thing: buy my course,
Always.
and I will
True.
teach you how to do this. And you're like, okay, like the internet is YouTube is filled with free everything.
Yeah.
Like, I don't need to buy your course to.
No, everyone has a course
Yeah.
at this point. So if someone's struggling financially right now, what's the first thing they should do this month? Do you think?
Section 179 deduction. Buy a G-Wagon tomorrow. I'm kidding. I'm kidding.
no.
Don't
All right,
get-
cut it
noted.
out.
Cut that part. Don't get me in trouble, please. If they're struggling financially, yeah. So I mean, I think the first step with any, like, it doesn't matter. The family with us has $100 million or $1 million or $10,000. You have to understand the cash flow. Everybody goes through the same like initial exercise with us. We call it CCBS. Cash flow is king. Your calendar, like what's coming up over the next like 1, 3, 5, 7 years that you know about. Let's just get that on the calendar so we know that like your friend's getting married, you're going to be in a wedding in Mexico. We have that next year. Okay, we know that's already on the calendar for 2027. What do we need to be doing ahead of time to make sure we have money put away for that? So we do the calendar, the cash flow, and then your balance sheet. If you could take, and your balance sheet is just what you own and what you owe. If you could take inventory of those three things, I think you can start to like piece together some semblance of a plan. Cash flow is like the king of everything though. What comes in, what goes out? What can you control that's coming in and out of your life? I know I made the joke about Starbucks earlier. You going to stop going to Starbucks to save like $5, that's probably not going to make the
It's not
difference for most.
life-altering.
Right, it's like
Right.
No.
for most people, it's more money. Like figure out a way to like make more money. For everybody, that's not possible. But for many people, like that, unfortunately, is like the right answer. But I think if you can start with that and just start getting like some semblance of a budget together, like know where your money is going month to month. If you don't know where the money's going, you already are like behind
You're
the eight ball
behind.
there. So
You're super behind.
start with just like pull the credit card statement. It's boring. Don't get me wrong. I don't love doing it either.
Start some fights too.
Yeah, you're gonna if you're married, you're gonna get into
You're
it,
asking for it.
and it's an uncomfortable conversation. That's why
tough.
that like most people don't want to do it, and it's part of why I have a job. But like, so like I'm, obviously grateful for that perspective. But like I don't want to do it for myself, so I get why other people don't want to do it. But I would start. That's where I would start, and like that. And if you can have an objective third party like an advisor help through some of those conversations. I do pro bono work for like family members of clients or people that are in like really tough scenarios. Like I just do it after work. And like, I just try to be a good person and try to give back.
That's cool.
And I also like am enrolled with the CFP board to like do pro bono work more broadly. Cause I get it. Like people face like really, really hard challenges. And unfortunately to like hire somebody full time like myself, it's expensive.
Yeah.
So like,
It's hard to like ask to like
oh my
when
God.
you're in a really bad spot. Like where do you, how do you ask somebody for help essentially?
Yeah. And for free. Cause like it's either
And
like
for
you're going to
free.
pay full price or like it wouldn't like be like, oh, you just give me $50. Like we're not going to do
Right.
that. Let's not do that. Let's just let me help you for free. And you owe me nothing. I just need we need to get this stuff straightened out.
That's
That's
sweet.
awesome.
Oh, that's awesome.
For sure. So, I mean, if anybody wants to, reach out, learn more about you, where can they find it?
So I write a fair amount on LinkedIn. It's been much less consistent with how busy I've been over the past 6 months, which is a really good busy. I'm not complaining about anything. So LinkedIn, sunpointinvestments.com is where almost everything we do gets posted as well. And then obviously our Sunpoint LinkedIn page, our marketing team does a good job of getting our stuff out there. And then obviously if you find me on social media, you can send me a DM, or my phone number is probably all over our website too. So like you can reach out to me there and start a conversation.
Now let's get everybody to follow Ben on LinkedIn. He posts some really good stuff, and obviously, like he said, it's not the fluff of the juicy stuff, but it's real and it's the truth. So great follow, and we'll put all the links at the bottom so you guys can reach out and give him a follow.
Absolutely.
Dude, thanks for coming.
Yeah, thanks so much.
Thanks for
This
spending
was
the
great.
time.
Thanks for having me,
Great.
guys.
Of course.
Really appreciate it.